welcome everyone. मेरे साथ, of course, Venugopal sir. He so kindly agreed to give us some time and help us navigate these markets. These are interesting times. Union budget आया है. Markets हर रोज एक नया all time high दिखाते हैं. And in such a scenario, we'll try to learn from sir what to do in this market, what is happening right now. Sir, the mic is all yours. We are here to learn.
Sure. Thank you, Vishu. I'll quickly take you through a presentation. There are a couple of slides or maybe one slide on the budget. There's hardly much to talk about except some, the tax changes, which I think has been analyzed to death. So there's not too much more to talk about. Maybe you guys know better, on the tax changes than me. So what I will do is I will run you through the market outlook presentation. And we maybe finish this in about half an hour's time or less maybe, and then you can ask questions if you have. I hope you can see the screens, the
Yes, yes,
presentation on the screen.
yes,
Okay.
I can.
Okay, so we just so the backdrop is what you see on the screen. So the markets have scaled up quite well over the last few years, at least the last 3 years or 4 years now. The key reason for that is on the screen. We believe that the economy has been performing very well. It is a fairly large sized economy now, 3.8 trillion US dollars, expected to double in the next 7 years or so, given the fact that we are compounding at a rate of about 10.5% or so. And in the which makes us possibly one of the top three over the next few years. So we are adding approximately $1 trillion to the GDP every 1.5 years. One of the few large economies which are compounding at 10% plus, or is expected to compound at 10% plus over the next 5 years or so. One of the few large economies adding more than about $450 billion of economic output almost every year. Interestingly, we are at where China was at 2006, and that's the excitement all about India, because we have seen China grow from there to a 10.5, $11 trillion economy by 2014, 3x in 7 years post that. So that's the kind of trajectory that we are looking at. Maybe the percentage gains or increase may be less because of the circumstances, because of world markets, the world economy, geopolitics, and many other factors. But we are looking at a strong growth trend over the next few years. For the Indian economy. Last year, we clocked about 8.2%, as you know, in terms of GDP growth. That was a surprise, especially the fourth quarter was a positive surprise. This year, I think the expectation is 7% plus, so or around 7% or so. I think even the IMF has increased the forecast for this financial year. We are expecting this trend to continue for the next few years, and that's why I said we'll compound it probably 10% in nominal terms over the next 5 years or so. If you look at the macroeconomic parameters that we have today, it is probably one of the best that we've had in so many years. The government has been very focused on fiscal consolidation, so the last year actual numbers you've seen coming at 5.6% of GDP versus the estimated or budgeted number of 5.8%. So that's been a improvement over the budgeted number. Further, this year, the expectation was that it will be 5.1%. The interim budget said 5.1%, but now that has got revised to 4.9%. So we've again seen a upgrade or a better number as time progressed, and government has been sticking to that fiscal consolidation map. What is important, to note here is that given that the fiscal deficit numbers are coming down post that COVID, outlier number that we saw in 2020 in FY21. Post that, we have seen a declining trend. We are likely to reach 4.5% as targeted by FY26. And what this means effectively is that the overall debt to GDP ratio is likely to come down further. It was at 89% of GDP in FY21, from where it has come down to 83% by 23. And we are looking at a further decline, given that on the denominator you have the GDP, which is compounding at 10%, and on the numerator you have the deficit numbers, which are dropping. So on both sides, you are getting a good positive trend. So to that extent, the overall debt to GDP numbers are likely to contract even further. And this augurs well for the economy. This augurs well in the context of many large economies really struggling with their deficits. US on one side, and the West with large deficits. And if the Republicans come to power, maybe that deficit is would expand even further. On the eastern side, you have China, which has again significant debt on the books, consumer debt as well, but that is largely internal. So, in the context of a world economy with many large nations having significant debt on the books, India really stands out. Apart from this, many other factors, including the current account deficit, is under control. Inflation has been behaving well. Core inflation has been under the or within the norms that RBI had set itself. Um, uh, uh, Reported CPI numbers have been higher than expectations. I mean, in the recent past, they've spiked a little with the fruits and vegetables prices having gone up or spiked. This is something that we see almost every year, so I don't think we need to read too much into this. I think by end of this year, inflation should again reported numbers also should fall within comfortable range. The expectation currently is that by end of the year, you should see some rate cuts happening. The extent of rate cuts would also depend on how the U.S. economy and the U.S. Fed behaves in terms of their interest rate cuts. So overall, I think it's a extremely strong macroeconomic scenario at this point in time, and that is the backdrop for markets to do well. There are several drivers for the performance of the economy. Some structural factors, which I'm sure we've spoken in the past also. Some reforms that have taken place post 2016. We saw the GST implementation, then we saw RERA, land reforms, and then the bankruptcy law. All of that has actually resulted in the Indian economy being set on a platform from where the growth can accelerate. And that has been accelerated also. I mean, an additional catalyst has been the digitization trends post-COVID, the internet penetration, and that driving, digitization trends. All of these have put India on that pedestal from where the growth can be accelerated. So structurally, it is absolutely at the on the right platform to grow. Um, uh, there are four additional pillars that we see at the moment outside of the structural reforms that we've seen. Those are on the screen. The first is infrastructure and reality. That's been one key driver for growth over the last 3 years or so, or not just the last 3 years, I think almost the last 5 years. Manufacturing is a second. That's been a big driver of growth, and we believe this is going to continue for quite some time. The third one is the consumption piece, which is the more stable, steady growth driver. This is largely demographics driven, and irrespective of governments and where the world economy is. The fourth is the financialization of the economy, and this is something where all of us are a part of, and we can see it almost on everyday basis. I'll just take you through these one by one, maybe spend a few minutes. Infrastructure has been a core driver of growth for especially since this government has taken charge, and over the last 5-6 years now, government expenditure as a percentage of GDP is at a multi-year high. It's the spending has grown by about 3x between FY20 and 24. You can see on the right hand side chart that the capital expenditure as a percentage of total expenditure from the center has gone up to about 23% or so. That's up from about 11.5 or 12%, so almost doubling in the last 3.5 years time. Also, if you look at capital expenditure to GDP as a percentage, that's also gone up from about 1.5% to almost 3.4%. So again, more than doubling over the last 4 years or so. On the left-hand side, you can see gross capital formation as a percentage of GDP. We have seen about 250 to 300 basis points improvement from the bottom that was made in FY21. We are at about 30.5 or 30.68 or so. The expectation is that this will go to 31.5 by FY25. This chart also indicates that we are not close to the peak of the cycle, given that the last peak in FY08 we were at about 35%, or sorry, 35% or close to that. And therefore, there is still room for gross capital formation to expand. The government seems to be focusing significantly on this. The idea being to make corporate India more competitive, to make costs or reduce the costs in the economy, and also to improve the overall life of the consumers. So the country is likely to spend about $1.7 trillion on infrastructure over the next 7 fiscals till 2030, which is more than double of what it has spent in the last 7 years. Just a breakup of the spend between corporates, the state government and the central government. You can see that the central government spending has been the fastest growing, from 4.3% of GDP in FY21, 4.3 trillion to about 11.1 trillion, as was announced in the budget recently for FY25. So that's almost a 3 times increase in central government capex. State governments have been moving in tandem, but to a lesser extent, and I think this is likely to only increase as we go forward. There's also been some assistance announced by the central government to states if they are doing more work on the infrastructure side. And the good thing is that over the last few years, we have seen that most state governments are trying to do what the central government has been doing. They're convinced that that's the way to progress and to ensure that to play the development plank, and that's what most state governments also now doing. So to that extent, there is a race for getting infrastructure on track, to have the best infrastructure in place. The corporate capex cycle has not fully expanded and played out. In pockets, however, we see corporate capex cycle playing out. So in cement sector, for example, or chemicals and many other sectors, you see some bit of capex happening, but it's not what we saw between 2003 to 2007. I think there is still some time before that happens, and it probably may not be a similar story like we saw between 2003 and 2008. It might still, it might be different sectors at different points in time which will take up capex going forward. In terms of the overall spend, this is just an illustrative chart. There may be more segments that are part of this infrastructure investment theme. And the classification also may be different in many respects. But suffice to say that some big segments like power, railways, irrigation, these are big drivers of growth for investments. Power is something that we've seen the government spend, government's focus going to the renewable side. Given the commitments that we've given, I think the government is committed to about setting up about 500 gigawatts of non-fossil based power, which is renewable power by 2030. I think we are nowhere close to that now, but over the next 7 years or so, we should get to that target or somewhere close to that target. Along with this, because of the peak deficits increasing, given the fact that renewables is not a stable, steady power generating capacity, you need balancing capacity, and therefore, the government is now focusing on setting up thermal capacity as well. So over the next 5 or 7 years, we'll hear about thermal capacities also getting commissioned. So I think. Overall, I think this is going to be a very big driver of growth for investments within investments. Apart from that, I think more than 25 cities are working on metro rail. Mumbai also being one of the large ones. There's a large amount of money earmarked for the rapid transit system, the bullet trains, and all of that. So multiple segments which are really taking this investment forward. Just a pictorial representation. Probably many of you have seen this. The top one is the solar park, which is the largest solar park in the world. It is in the Thar Desert, covers about 56 square kilometers, total installed capacity of about 2.25 gigawatts. This is in a very difficult terrain with a lot of sandstorms all the time, and however, this is generating power to the tune of about 2.25 gigawatts. uh, the right hand side top is the Mumbai's coastal road. Many of us are using it. There are two undersea tunnels stretching more than 2 kilometers under the Arabian Sea, and this is a marvel. First time we've seen this in India. On the left hand side bottom is the world's highest railway bridge. This is over the Chenab river. This is in J&K. And this is, at the center point. It is 359 meters high. It's about 35 meters taller than the Eiffel Tower at the center. Just imagining something like this and with a train going on top is like science fiction. So, and this has been constructed considering the earthquake-prone, characteristics of the region, and this can withstand earthquakes up to a certain magnitude. So this is again the kind of quality of infrastructure that we are building today. And just to give some appreciation or sense of what's happening in the country, I've just put these slides. Real estate is a segment that has a long cycle. So between 2011 and 2020, we saw a declining phase, a contraction phase, with the excesses of the previous cycle getting used up or utilized. And from FY21 or 22 onwards, you're seeing the absorption rates increase and unsold inventory levels come down. Today, we are at a much better situation with unsold inventory levels dropping, and many parts of India, you're seeing many micro markets, you're seeing prices moving up quite significantly. The affordability rates are among the best. This is at a time when interest rates are at a high for the cycle, and we are expecting interest rates to come down further, and therefore affordability is going to only improve as we go forward. The second theme is manufacturing. The government from 2019 has been focusing on this theme, and wants to increase the percentage of GDP coming from manufacturing from 15% currently to about 20% by 2030. And for that, they've been giving incentives. The PLI incentive is one for more than 14 different sectors with about $35 billion of allocation. You can see that electronics is a segment where as an example, you can see that that's growing at a very fast pace, almost going 5 times from 2023 levels. Overall, corporate capex is gradually likely to pick up. I think the balance sheets are very strong today. Utilization levels are still low, at about 74, 75%. There is still room for it to expand. Last cycle peak levels were more than 80%. Corporate profits to GDP also are expanding from the bottom made at 1.1% in FY20 to about 5% now. But again, as you can see in FY08, it was close to 7% or more. So all in all, I think there is some room for expansion in terms of corporate profits. There is expand room for expansion in terms of utilization levels for companies. Corporate debt levels are at its lowest. And that's reflected in the asset quality for banks as well. So it's again from a I showed you how the macroeconomic parameters are are stacking up. I think corporate data is also looking quite good. Electronics, I mentioned, I won't spend time on this, is expected to increase by about 4 times between FY21 and 26. Mobile phones is one of the key segments where we were big importers of mobile phones in the past. Today, we are the second largest exporter of mobile phones from the country. So, similar to this, there are other segments like consumer durables and industrial electronics and consumer electronics, which are also now gaining traction in terms of manufacturing capability. And in multiple other segments, we are also taking market share in the global scenario with the supply chain for alternates, versus China. The third piece is consumption. This is largely driven by the large population, 140 crore population. The per capita GDP is rising from currently about 2,700 or so, 800 or so, to about 5,000 plus dollars by 2030. The middle class segment is actually the fastest growing. That's growing much more than the bottom end. The bottom end is actually moving up, so the pyramid structure of households is going to move to a diamond shape by 2030. There's a lot of urbanization happening. So from the small towns and cities, people are migrating to the urban centers for work. The average age of this population is just about 29 years. The working age population is about 67%, which is going to about 68.4% by 2030. All of this is actually likely to lead to a significant increase in per capita, a significant increase in discretionary consumption, given that the additional, beyond $2,000, the additional income that comes to a family we have seen that in other economies as well, that the incremental income will be used for discretionary spending. We've seen how this has played out in the US from the 1950s, in Japan between 1960s to 1980s, and China from 2006 onwards. You generally see a hockey stick kind of move in consumption, and that's what is likely to be seen in India as well. The last piece is financialization. We are all part of this, as I mentioned earlier, in terms of the flows from household savings into the capital market. So the market-linked savings is actually growing much faster than most other savings assets. It's also visible in terms of the number of investors in the market, the depository participants growing, the SIPs, and all these data is available to all of you. We are all part of this, so I don't need to spend too much time on this. I think this is a big trend. We believe that India is where the US was in the 1980s when it comes to financialization. The 401k plans, began or was introduced in the US in I think 1978 or 79, and from 2000 from 1980s to 2000s, we saw a big retail rush into the markets, and the markets also behaving extremely well. So that's something that we are looking at to happen in India as well. So we believe that this is just the beginning of flows into the capital markets. Why India now? The scale up that we have seen in the equity markets in 2024 is a result of the strong economic data, and I showed you the drivers of that. This is also being driven by strong, earnings growth trend. This last 2-3 years, we've seen earnings growth pick up. That was not the case between 2016 and 2018. Markets did reasonably well, but not it was not backed by strong earnings growth trend. Now we are getting that, and therefore the market move is far more fundamentals driven. This is an area where we are slightly differentiated in our approach and thinking versus most others. Um, Mid and small caps have delivered high returns. We believe that the possibility of generating alpha is better on the mid and small cap side even today. Over the next 3 to 5 years, there is more to come from the mid and small cap end, and I think this is the most exciting part of the market. At this point in time. There are multiple reasons for it. I think the this broad market, which includes mid and small caps, do very well during high, strong growth environments, and very conducive growth environments. I think we are in one of that kind of a phase at this point in time. Economic growth is strong, 7%, 10% compounding on nominal terms. Commodity prices are low. Interest rates are at its even though it's at its peak for the cycle, they're still low compared to what interest rates we've seen in the past, and we are expecting interest rates to come down further. Tax levels are have been reduced and are at its low. There are government incentives for multiple sectors of the economy. The global markets are open for Indian companies, and all of this is actually beneficial for a large number of small companies, and the structural reforms are also ensuring that there is a shift from the unorganized sector to the organized sector. So we are seeing structurally the mid and small cap market doing far better, and we believe that this is a trend that we will continue to see going forward. Also, if you are positive on the manufacturing and the investment side, many of those sectors and stocks are part of the mid and small cap basket. There are hardly a few large caps in that space. It's more smaller companies than the defensive sectors of consumer staples, banking, and IT. Um, if you look at the sectors that have performed well, it's been realty, infrastructure, auto, and those sectors have really done well. In the past, we've seen IT and banking really keeping the index floating. Rest of the sectors not really participating. But over the last 3 years, we've seen that changing quite significantly. Many of these sectors are now participating. So there is a broad basing of sectors and performance across markets. Infra has been one of the biggest drivers and continues to be the one of the best performing indices. Auto has done very well. We believe that's played out quite a bit. We are more positive on two-wheelers at this point in time. Realty, we think, will continue to outperform. There is still, legs for this to continue with its performance. IT is something that has had not done well for some time. Now it's recovered a bit. There has been a lot of deal wins in the last year. Some of that will transpire into revenue growth as we go into the second half and into FY26. So it's a little, slow moving at this point in time. I think there are still some uncertainties, and so it's recovering, but it's a gradual recovery, and you need to play it accordingly. Banks are something that we are underweight at this point in time. We are not very positive on the private banks. We are more positive on public sector banks at this point in time. Banks are struggling, on the liability side. Their deposits growth has been weak, and there's a fight for deposits to that extent. There is NIM compression. We're also seeing in many pockets the unsecured credit becoming a concern, and NPLs going up a bit. And interest rates are peaking out and have peaked out and should come down over the next 8 to 10 months. So we are not, very positive on the banks, though I think the results and the numbers will continue to be, to continue to give some stability to the overall earnings growth. I spoke about this. The corporate profits to GDP is at a multi-year high, but the peak numbers are, of the past cycle we've not reached yet. In terms of earnings growth, we are looking at about 18 to 19% growth, or you can say 15 to 20% growth for the next 2 3 years. The magnifying glass shown there, we've seen that's the period between 2003 and 2008. We saw the Nifty earnings grow by about 24% or so. So again, it's not the best that we are seeing currently. We've seen better numbers in the past, so we can still, catch up and improve. And the Nifty also at that time gave a significant CAGR over the 5-year period. Valuations, I think large caps are more attractive on a relative basis. The ROE is also expanding for the Nifty. It's at 16% or so. Um, uh, the valuations of the mid and small caps are definitely higher, more than one standard deviation above the average. Here again, we believe that the small cap segment is the largest, with more than 500 or 550 companies which are investable, and not all of them are in the same category, not all of them are in the same sector. There are so many different sectors, very diverse, and valuations are very different. Again, if you look at the growth numbers and the ROEs also, they are expanding. To that extent, there is justification for slightly higher valuation for the mid and small cap side. Having said that, corrections can happen. I think we might see corrections at some point in the in this journey, but corrections we believe should be bought into. We have a slightly differentiated view, therefore, on the broad market, the mid and small cap side. Another justification for the mid and small caps, I believe this is the most exciting space for the markets, and you can see that the growing segments of capital goods, chemicals, realty, consumer discretionary, many of them are not represented well in the large cap space. They're more on the mid and small caps. If you look at the last 2-year data in terms of IPOs also, you can see that there are a large number of new companies and new sectors that have got listed. This is a reflection of, we believe, the developing phase of the economy, and the an economy really coming to scale, reaching scale. So many of these are being listed, have been listed for the first time in India. We've never had sectors like, for example, auto dealerships or school stationery or airport management or luxury furniture or any of such segments in the listed space. They were always in the informal, unlisted space with less scale. Now, we are at a situation where these are large enough to get listed, and we are seeing those listings happening. So this is again largely in the mid and small cap space, largely in the small cap space, I would say. So to that extent, we continue to like this space. More and more new sectors and stocks are getting added, and for the 140 crore population, with the demographic profile we have, we will need far more number of such consumer facing companies in the listed space, and these will only grow over the next 5, 7, 10 years, and that's the most exciting space for me. Just roundup of the 24-25 budget. I not spending too much time on this. Maybe you can take questions, but the fiscal deficit or consolidation roadmap has been one of the most important feature of this budget. 4.9% targeted for FY25 and 4.5% for FY26. That's a very, very positive outcome. Some of the numbers are also very conservative, in especially tax numbers, considering the tax buoyancy of the last year, actual achieved numbers. The tax buoyancy that has been budgeted in this for this financial year has been very conservative. So I think there is a fair chance that the 25 numbers also will be beaten, which is the way it is in a strong bull market. I mean, a strong growing economy. I think the outperformance versus the earlier budgeted numbers is something that is a character of a strong market. So I think that's one of the big factors. Government capex continues to be strong, so about 15% growth was forecasted in the interim budget. I think this one continues with the same set of numbers. Focus on the key sectors like energy, manufacturing, etc. continues. There is a lot of focus on employment generation and employment skilling. Skilling of people. So a lot of this is actually also focused on the manufacturing sector. This is all going as incentives for companies to really work on improving the quality of people and hiring more people. Some rationalization of taxes, I think this has been the most talked about. and arguably some of this could be taken as negative for the near term. But I think some of this was expected probably in if not now, in February of next year. But it has come, and I don't think it's been a very big move. 10 to 20, 12.5%, even though it's a 25% increase, it's not really going to hurt too much. And short-term gains also been raised. There is the indexation for immovable property, which has been removed, indexation benefit. Again, lot of debate and discussion around this. I don't think it is going to materially impact the real estate space. And to the extent that the set-offs for if you buy another property after selling one, the set-offs are continuing. I don't think this is going to make a big difference for investors in the real estate space, or and it's not anyway going to make a big difference for the first-time purchasers or the genuine buyers who are coming into the real estate space. So that's broadly it. As a portfolio update, I don't think we've made any big changes there. The stance continues to be on the cyclical sectors of the economy: infrastructure, investments, consumer discretionary, real estate. All of those are the key segments we are positive on. We are positive on the mid and small cap side of the market. We continue to be bottom up in our approach to investing, and we think that is how markets will reward going forward as well. Just one last slide on the flows. You can see that FIIs, have been reducing their exposure to some extent. I think they have been underweight also compared to the MSCI index. The weight has gone up in the MSCI index, but the FIs have been sellers or have not been really adding to their overall positions. Domestic institutions, however, have been increasing. I think this is a trend that we believe is just at the early stage. FI selling could be because of various reasons. It could be, just profit booking, given that valuations are high. It could also be some redemptions in the global emerging markets, and some region-specific funds. But and it also is reflecting in the selling that we are seeing, or the on the underperformance we are seeing in some of the financial institutions, and some bit of IT as well. Um, but we believe that this is not a structural trend. We think that the FIIs will come back strongly, especially given that our correlation to global markets have gone down significantly. Our currency has also been very, very stable, so I don't see a big reason why FIIs will be negative for long. And so to that extent, I think we are quite positive overall on flows as well. That's it from my side. If you have any specific questions, happy to take them now.
That was certainly a very, very comprehensive presentation, sir. Thank you so much for so many insights from your side. I don't think I have any. I have a lot of questions. Just one, if I could request you for a one final concluding advice for our viewers out there. It may be related to the current market scenario or the budget, or otherwise, that they should always take care of. Anything from your side, we'd be happy.
Yeah, I think one has to be careful definitely while investing. I think across the market, lots of stocks have moved up. Some have fundamentals, some don't. So one has to be really careful about investing. Also, if you are into good segments, into good companies with runway of growth, and backed by good people with integrity, I think you should remain invested patiently. India is on a strong footing for the next 5 7 years, and the next decade belongs to India. And so if you step out of this market thinking that valuations are high, and you will get back in at some point when there is a correction, I think that's a to my mind, a very, very wishful kind of approach. And many a times the risk is more when you step out of the market than when you are in. So back your conviction. If you are a believer in India, back the good funds, or back the good companies that you're invested in, and stay invested for the returns to unfold over the longer term. Your return expectations for the near term will have to be moderated, given that we've had a very strong run up in the markets, and valuations have also moved up. So I think the near term return expectations will have to be subdued and moderated. But the fact remains that India is one of the most exciting markets to be in, and we shouldn't miss out the opportunity.
Absolutely, sir. So this was very helpful. I hope you'll allow us to learn more from you in future.
Thank you. Yeah, absolutely. Anytime, whatever I
Thank you for your
can.
time.
Investments in securities market are subject to market risks. Read all related documents carefully before investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.